Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 6th, 2025, D-Day. S&P 500 currently sitting at 5,994. I'm David Zarling. I'm here with Ian McMillan, back from your trip. Ian, welcome back.
Thank you.
Hopefully it was restful.
It was. Hard not to relax when you're at the beach. I think so.
Dealing with the Godzilla waves.
Godzilla waves, yes. Always a fun time.
Yeah, sometimes that sounds like a technical analysis pattern, Godzilla wave.
Hey, maybe he's onto something.
Yeah, maybe we caught something. And I know that you and I tried to get into a Twitter argument yesterday. We got a little overshadowed, didn't we?
Yeah, definitely a hot day. I guess the markets, I don't know. I don't know if the markets sold off yesterday. Now when I say sold off, that like they crashed. But we're above where we were when all that went down.
Yep.
Holding up well. Another pretty solid week for stocks.
Yeah, I find it fascinating. You know, we had a red day yesterday, but minus 0.5% on something like S&P 500. And I've got my mom texting me, my kids saying something, soccer players at practice bringing up this Elon versus Trump interaction. Just goes to show one day does not make a trend. And I don't think we get to say that the market tanked.
No, certainly not. Some stocks, I guess, hit pretty hard. Tesla, maybe that one's not such a surprise, but we'll see.
Yeah, we will. And we have the S&P 500 battling the 6,000 level, which it has been for a little while here, but we are sustaining trade above a 200-day moving average. You know, you wrote a client letter that's going to be going out talking about that. That's an important thing that we want to see is can buyers sustain trade above a 200-day moving average, and so far so good.
We have, and we've traded sideways. I mean, really since early May, depending on what index. I mean, we were in a 2 to 3 week consolidation for the Russell, NASDAQ 100, and both of those moving out of those consolidations to the upside. Again, not surprising. Russell's still also not surprising that it has the most work to do.
It does, but I think, you know, going through the domestic indices, S&P above a 200-day, Q's above a 200-day, Dow Jones above a 200-day, no small caps IWM, but it is above a volume weighted average price from all-time highs, which began today. And that doesn't hurt. I mean, that's further confirmation if we're checking boxes of confirmation of or refutation, like further confirmation of probable sustained strength. We'll see. And then if we look at different areas of U.S. markets that are doing well, you have your FANG stocks making new all-time highs, tech overall doing well with Microsoft at new all-time highs. I mean, that's pretty significant. It's one of the most bullish things you can do is record a new all-time high.
Impossible. Never happened in a bear market, right?
That's right.
Yeah, Microsoft, a big one, especially with Apple being kind of stagnant. So, yeah, these pockets. And, of course, I mean, I would say tech as a whole continues to lead. Communication services. So some of those Mag 7-ish and FANG-ish, the semiconductors, similar to the playbook that we have been given the last 4 or 5 years.
Yeah, I mean, if you're going to talk about tech stocks doing well, semiconductor stocks doing well, your Mag 7 hanging in there. I forget if I said semiconductors, communication services, and we even haven't talked about financials, whether it's domestic or international. And if you have those doing well, it's really hard. Those are not bearish characteristics to have those areas doing well and leading the way.
Speaking of foreign stocks. Is it time to? Are we going all in?
I think there's time yet. If you look at something like VEU versus S&P, which we've talked about, which feels like the last 2 months, still below a downward rate of trend versus the S&P, but there's definitely pockets. I mean, you see the DAX going out at all-time highs. You see things like Austria or Spain. So there's definitely pockets internationally worth having exposure to. But as far as flipping the entire book and being international, I mean, the signs are starting to continue to build for that. But we need further evidence for that to be a sustained case. I mean, European financials going out to new highs is pretty important. And it's a, ETF and indice makeup consideration here too, right? U.S. indices are tilted towards tech growth, internationals tilted towards financials. So seeing that international financial strength, I don't think that hurts for the bullish case for stocks overall, but as far as flipping the book, probably not yet.
Yeah, pretty flat relative charts. I look like an EFA, pretty flat since mid-March. Coming up on the last 2-3 months. Not a lot of alpha one way or the other, I would say.
Yeah,
certainly had the big move, got a lot of attention, and they look good. They do look good on an absolute basis. But yeah, waiting to see if this kind of turns out. I mean, right, we saw this kind of like January 2023, big move. Foreign starts to outperform. We peter out, and then we go lower for another year in the relative relationship. Feels better, though. It feels better under the surface this time. Maybe that's anecdotal. I don't know.
I think that's fair. I mean, and when you look international, what's interesting about it is just, you look at a VEA, developed markets versus emerging markets. Mm-hmm. I mean, it's since the beginning of the year or late last year, and arguably since 2021, it's been developed markets over emerging markets. Be interesting to watch that continue.
Yeah, it's quite the chart. If that were to, yeah.
So if you're going to be international, it goes to, just the same as not all U.S. stocks are the same. Not all international stocks, not all international areas are the same. So can you own some international? Absolutely. Our clients are familiar that we do, but nothing crazy at this point. It's not taking on and flipping completely away from domestic all the way into international. Plenty of time for that. If that's going to be a multi-year, multi-decade move.
Yeah, we're not just throwing out S&P like that.
Right.
What about Bitcoin?
Coins a bit. Yeah.
A little bit. Having a good day today. Kind of. I'd qualify certainly as a failed breakout. So, yeah, get back above 107, right? Or at least to me.
Yeah.
And the relative chart's the relative chart hasn't fallen apart, but it needs some work. Short term, obviously long term. We know Bitcoin is pretty solid outperformer, can go through some pretty strong uptrends. So we'll see.
Yeah, I think your point is just on an absolute basis, getting back above that 107 level would be nice and would provide a consolidation above the prior highs that you can operate off of and manage risk with. But definitely just have to be aware that false breakouts on the table. Be patient, let it develop, let the buyers and sellers interact and see where demand and supply take Bitcoin. I know, for example, Ripple, whether you look at it on a relative basis versus the S&P or you just look at it straight up, it's at the lower bound of the range that it's been in since late 2024. So if that can hold, definitely can move higher. So crypto's been meandering. What are we seeing out of commodities?
Well, we've still got your crude. Although crude is kind of brought itself back up to like $65, which is a pretty big area. We'll see if this turns into some type of, I don't know. Okay, I'm going to segue here with a question. Does a failed breakdown have a time limit on it?
Okay. Do we have a chart?
Okay, so crude, if it gets back above 65, is that a failed breakdown?
Hmm. I mean, I like where you're going with this. You're saying like this breakdown is taking too long in your mind, potentially.
Yeah, and I'm not saying that it could clearly can go above, back above. So I'm not trying to say like now we spent too much time below 65. I'm just saying if it does go back above, does that fall into like a failure category? Or do failures need to be quote unquote quicker?
Oh yeah. I mean, I think that's a fair question. I would think if I can flip it a little bit, if we're above 65, all I know is you don't want to be short oil.
It's true.
And if shorts were piling up in this area between, you know, $56 and $64 a barrel, that they could be in a world of hurt pretty quick here. And a lot of times that's actually what's happened is you get a breakdown below a certain level, the shorts pile in, it reverses on, and the short squeezes on. So I guess it all depends on what our short short positioning is in oil. And if that's the case, I mean, you could see oil move quickly here. Doesn't have to. I mean, there you see plenty of times where price gets back above and then consolidates and breaks back down and moves further down. I mean, it is still below a falling 200-day on an absolute basis. But if you were going to get long crude oil here, I've seen worse spots to try to do that. I mean, you're basically a buck away from being wrong, so that's low risk. But yeah, I don't know that they're I yes, I the ones that seem to be the most powerful are the ones that are quicker.
Yeah.
I think
Maybe
that's
that's the
fair.
moral that we're looking for here.
Yeah, no, I think that's a great question. And I think the faster the move, right, the the more likelihood of a reversal that happens quick. And so your point is just simply it's been below, $64 going on since the beginning of April. What does this look like if we get above 65? Be interesting to watch.
For sure.
What about transportation stocks?
Terrible. Terrible, terrible. Part of that's to do with the weightings. But yeah, I mean, even your classic transportation stuff, Old Dominion, things like that. FedEx. What's FedEx? So see, I mean, none of this stuff ever pops up on my screens. FedEx, terrible.
Yeah, UPS. I mean, UPS was
UPS, trucking in
still,
general is just rough.
I mean, UPS remains in a 57% drawdown. FedEx remains in a, what is this? If I can get my mouse to work, 30% drawdown. And IYT representing transports overall. I mean, we're still at the same price level we were back in May of 2021. So nothing but a bunch of heartburn in between May 2021 and now for transports. For all those Dow theorists out there, you'd kind of like to see that confirmed.
Yeah, it's a good point. But they have gone nowhere.
No, not great.
You asked about commodities. I don't know. I mean, pretty mixed. I think silver got to new highs this week. Palladium's having a good time.
Yeah, Palladium doesn't get a lot of airtime on here.
Platinum even better. Platinum very, very strong. I mean, gold's still doing well. I mentioned silver. Lean hogs, new highs.
Doesn't lean hog sound like an oxymoron?
I mean, I hope. Yeah, I don't know hogs to be lean.
Yeah, you're such a pig, but you're one of the lean ones.
Cattle, new highs. Live cattle.
Live cattle that are eventually going to not be live.
Yeah.
So some things, and when you look at commodities overall, like, you look at something like a GCC,
Yeah.
it's an interesting consolidation that's been going on an absolute basis since the beginning of 2024, that if that breaks to the upside, maybe you are seeing oil clear $65 and commodities moving higher, which you would think, your textbooks might say that means the dollar staying below 100 on a trade basis. Doesn't have to happen. But another one of those where if that's going to be a false breakdown in the dollar, boy, it feels like a little while here.
Well, haven't the dollar and crude been more correlated this year, or am I just
Yeah.
making that up?
No, you're on. So all of these things, it makes sense, right? If we're going to have a weak dollar, commodities would be perked up. You'd see some international strength, which we've seen in some areas. We'll see if I would say the next level on the dollar, that if it can't hold, would be $98. If we can't stay above $98 on a trade weighted dollar, probably seeing some of these commodities breaking further to the upside, more strength internationally. We'll see.
Yeah.
I mean, that's a thesis. Price has to confirm that. That's how we should operate, right? Nothing is.
They're trying hard at 98. They're trying hard to dig their heels in the sand. We'll see.
You got some bellwethers out there like JP Morgan holding up really well. You look at JP Morgan on a relative basis to the S&P. That's a level that goes back in time.
Yeah, when are we going to do this?
All the way to the late 80s. I know in our workbook coverage this week, American Express versus the S&P, major level that goes back to 1973.
All the credit card companies look so good. Banks, not so much, but
defense stocks, aerospace and defense remains strong. Some areas industrial, even global industrial look good. So none of these things are screaming, hey, get ready for the next, major correction. Can happen. I mean, if we lose a 200-day moving average, if we lose some of the levels that we talked about before, like an election gap, you lose some of these areas, or some of these do turn into false breakouts. Yeah, then a correction could be upon us. We can change our opinion in a week here. None of us are just married to our opinions. After all, we married our wives. That's who we're committed to. We don't have to be committed to our opinions. We can let price change our mind. Anything else that you're looking at that you'd like to highlight for our listeners? It could be bullish case, bearish case, just interesting. Like for me, I look at housing. Like if I look at XHB,
yeah,
it's interesting to note how weak that is. Where is that going to be 6 to 12 months out?
I like industrials. They don't get a lot of attention. Important spot on a relative chart. A lot of very strong individual stocks in the industrial space. A lot of mid-cappy stuff. That looks good.
I like that. So in your work this week, you're just saying underneath the hood.
Yeah.
When you're looking at individual stocks, a lot of mid-cap industrials. Also does not scream risk off.
Global infrastructure funds have been good.
Mm-hmm.
Those types of names. So I'd put that in like the industrials category. Obviously, we know about aerospace and defense. I mean, probably maybe the strongest sub-industry out there. Up there with like the gaming, esports stuff. Aerospace.
Yeah.
Very strong. Your PPAs and ITAs and all that.
And then when you throw like an international tilt on it, like Shield, SHLD, pretty strong. You highlighted even like nuclear, like nukes.
Yeah, nukes looks good. There's definitely things in the aerospace. And you mentioned home builders, but then you see some like the other pieces of home building, like a Badger meter.
Yeah.
Like those have stayed pretty strong. Builders themselves, yeah, definitely not so much. But there's pockets there. There certainly are. Not, I say not enough to make XLI, but XLI looks good.
Right.
And I think there's something to be said for getting back to all-time highs before the broad index does.
Yeah. No, that's fair, right? That the first ones to get the beach ball above the water, or
yeah, when you look back 6 months from now and we're sitting here post-Christmas, is industrials going to be, will it have been a leader? I mean, yeah, I think it's definitely that communication services.
Yeah.
And even stuff like, Staples is holding up. I hope Staples doesn't become a leader. Of course, I think it got hit last during the correction. So,
and it all matters the context of when it is a leader.
Yeah.
Is it in an absolute uptrend, or is it in an absolute downtrend and just going down at a less rate than everything else? Well, then that's definitely a warning sign. And I think the sketchy ones that I look at are like Home Depot and Lowe's on a relative basis. You tie that in with XHB, and maybe there's some things going on in housing, but you brought up Badger Meter. So time will tell. It's a mixed bag there for sure. But anytime you've got aerospace and defense, tech, semiconductors, international financials, I mean, even some of the domestic financials like capital markets and broker dealers, industrials, like these are all risk on type of environment. That's a risk on metric. And things like healthcare are not really participating in this. Materials, utilities.
Yeah, whatever happened to our friends over at UNH? Yeah, they haven't really recovered, have they?
Yeah. Well, now I know if you call me friend to consider it loose.
Oof. Yeah.
But yeah, UNH still remains brutal.
Another area ETF that is at new highs today, not all-time highs, but above its February highs, ARKW.
Yeah. A lot of the ARK funds.
ARKF it is there now. It was not there a couple hours ago, but it is now. Crypto stocks look good, like a block, BLOK right there.
Yep. Yeah, I think that's a good eye on ARKW. I mean, that's next generation internet. Definitely some strength in that area worth paying attention to. What about rates? Bonds, rates?
Rates, what everyone wants to talk about. So up today, I mean, we're still at the upper end of that range. Can't quite break 5% on the 30-year Treasury yield, but still sniffing around 4.96.
Well, you did a good job highlighting for our clients in the write-up this month, just the evidence still there, still building, that we're in a new 35, 4-year cycle for rising rates. We don't know what it looks like. We don't know what that cycle is going to look like, but obviously there'll be consolidations in there. But the evidence continues to suggest that, when Connor's an adult, he'll have some higher interest rates.
Yeah. Yeah. We don't know what it looks like. There's going to be periods like this. I mean, like we just laid out, we're at the same spot in the 30-year that we were in September 2023. That doesn't mean we're not in a rising rate cycle. You just have to think about this in the context of 30 to 40 years. And yeah, there's going to be periods. People get a 9% mortgage are going to be able to refinance it at 7%. Like that's going to happen during the cycle, but over the long term, next 3 to 4 decades, yeah, like you're going to see again. And I don't know if we get up to 13%. I don't know if we have 18% mortgages. There will be volatility. Of course there will be. And there's going to be times when we think, oh, it's over. Rates are going back down. They're probably not. Probably not going back to 3%. So yeah, just trying to provide context. Interest rates are something we talk about in the client letter every month. I think it is an important topic. Probably not so much during the ZIRP era, but people certainly care now. And usually those charts are like 2 to 3 year charts. And we talk about this kind of current range and everything. Yeah, just want to take some time to zoom out and say, hey, this is likely what, here's the direction we're going. And here's the 85 different paths it could take. But we are probably going this direction.
Yep, for sure. Well, at this time, I want to highlight the supporter of this podcast, the Adaptive Select ETF listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Anything else, Ian, you want to touch base on for our listeners?
No.
Before we ask them to give us a high ranking?
I think that is it. We've talked on international. To that, we touched on the dollar. so many things dollar dependent in this environment. I feel like we could really actually see dollar weakness maybe mean something.
Yeah.
We've been in this big range, and we see quote unquote dollar weakness, but between 107 and 101, I mean, it was kind of a nothing burger. Now that we're below 101 and sustaining that, it does seem like there's some real interest in, okay, what does it mean if we go into a multi-year period with a weak US dollar?
Yeah, I think that's a great point. You know, that that likely, because really you can make the argument that the trade weighted dollar hasn't been in any type of trend since the beginning of 2023. And your point is that if we see a new trend develop here to the downside for a trade weighted dollar, that's when you really are probably going to see some of these things materialize and sustain in such a way that maybe we are seeing a new uptrend in international stocks, commodities, even your crypto, things like that, because of a downtrend in the dollar. Is that a fair summary?
Yeah, I think that's a great way to put it.
Yeah, so we'll be able to look back at this episode and say, okay, was this period of time confirming a new down leg, new downtrend in the trade weighted dollar with some impact behind it? Time will tell. Well, I appreciate you doing this with me again, Ian. All those listening, we appreciate your listenership. We hope you guys appreciate this and are able to share with others and give us a high ranking on your platform of choice. Until next week, enjoy your weekend.
Have a great weekend, everyone.